Hello and welcome to Rajya Sabha Television. You're watching The Big Picture with me, Frank Razan Pereira. The Economic Survey 2019-20, tabled by Finance Minister Nirmala Sitharaman on Friday, projected growth for the next fiscal starting April 2020-21 at 6% to 6.5%. The pre-budget survey has also retained the growth numbers for the current fiscal at 5%. The annual economic survey, prepared by a team headed by the Chief Economic Advisor Krishnamurthy Subramanian, also stressed on the need to relax fiscal deficit for the current fiscal to revive growth. It also called for more reforms for making it easier to do business in the country. The survey observed that there is an urgent need to remove red tape at ports to promote exports, apart from eliminating other business hindrances such as registering property, paying taxes and enforcing contracts. While it mentioned that weak global growth has impacted India, it also acknowledged the fact that investment has slowed down due to domestic financial sector issues. The economic survey also said that the government must deliver on reforms quickly, as it is the only way to enable an economic recovery in the upcoming fiscal. Improving governance in public sector banks and the need for better disclosure of information are the key steps recommended by the economic survey. On this edition of The Big Picture, we will analyze the economic survey. Joining me on the program today are Abhinav Prakash, Assistant Professor, University of Delhi; A.K. Bhattacharya, Editorial Director of the Business Standard; and Jayant Dasgupta, former Secretary, Economic Advisory Council to the Prime Minister. All right, then, let's begin our discussion. Mr. Bhattacharya, let me begin the program with you. What's the health of the economy as seen through the economic survey?
Well, the economic survey acknowledges the central fact that the Indian economy has slowed down. It has in a sense reiterated the first advanced estimate figure put out by the Central Statistics Office, that economic growth for the current year will be 5%. But the important point the survey points to is that for the growth next year, it sees a significant jump, almost at least a minimum jump of 1 percentage point, and that is premised, in my view, on some green shoots of recovery that the survey sees in terms of whether it is the PMI index or whether it is some sort of a freight movement index, the ease of doing business getting better, and also a kind of a mega infrastructure plan that has been put in place. On the fiscal side, it expresses concern, and as a matter of fact, it reveals what I thought was a kind of a budget secret, that for the current year's fiscal deficit will be exceeded over 3.3%. But at the same time, it does expresses caution for next year's fiscal consolidation program, because when it talks about the need for increasing investment for the infrastructure sector, I thought the survey was very cautious in outlining the dangers of government investment increasing at a rate that might mean government borrowing more, which is nothing else but higher fiscal deficit, which will crowd out private investment based on borrowing. So that's the overall sense you get from the economic survey.
Right.
But there are two points I would mention about this survey. One, it provides an alternative assessment to the GDP growth story. It suggests that the addition of new firms in the economy is probably an alternative way of judging whether the current GDP level is underestimated or overestimated. That's one. And number two, it provides a very useful index for gauging the health of the financial sector, which it offers to policymakers, presumably in the government as well as to the Reserve Bank of India, which they can use that index for estimating and gauging and to sense if there are early signals of some stress developing in the financial sector. I thought these are the 2 points which are interesting highlights of this survey, apart from the point that you mentioned about the outcome and the outlook of the economy.
Okay, all right. So that was the macro as far as the economic survey is concerned. Let's go into the micro now. Mr. Dasgupta, let's talk about fiscal deficit. How much of a concern is it really, do you think, going forward?
The problem is that if we want to, stick to our target of 102,000 crores, lakh crores, and spend it on infrastructure, it has to come from somewhere. And if, as Mr. Bhattacharya also pointed out, there is this danger that if we, borrow from the market, it will crowd out private investments. The other alternative, of course, is if we are very efficient in divesting in the central public sector undertakings, we can perhaps generate that kind of resource. But because of the serious deficit in revenue collection, I think part of the proceeds of divestment of PSEs will probably go towards meeting our revenue expenditure. So that is a problem. But the fiscal deficit is bound to rise from 3.3%. And there are, I don't know whether this figure has been quoted in the economic survey or not, but there are projections that it will probably be around 3.8%. If we do not take the off balance sheet items, and of course if we take them in and then we also add the state government's deficit, then of course it goes beyond 8%. So it will have inflationary impact. And as we know that in the food price index, for instance, vegetables and a few other things, there has been an impact. So it can affect the common man. So, increasing the fiscal deficit can have a downside, apart from, of course, stimulating growth.
Right.
So we have to be mindful of that.
Sure. Okay. Ravindra Prakash, talking about figures, let's talk about a couple of important ones. The first one, of course, 5%. The growth, of course, is that the economic survey very clearly says that, only the next fiscal will it go up by 1 percentage point to 6 or 6.5. So the 5% growth figure, do you believe that that could be a worrying factor, could be a worrying area? How can we address that?
Yes, Frank. I mean, it's good that economic survey has acknowledged that there is a downside to the growth process now, that we are not achieving our full potential as we should have been. But the economic survey also, if you look at the volume 1 of the economic survey, it does acknowledges something which is very interesting in my opinion, that the wealth creation is more important. So far in the economic policies, we have been focused on eradicating poverty, whereas the real focus should be on the wealth creation. So it acknowledges that the wealth creation should be the prime agenda, prime goal of the policy making. And it goes on saying that it can only come by the entrepreneurship from the grassroots level, and gives data that India is one of the leading countries in the entrepreneurship, with the most of the factories and most of the new firms which are opening up. I think India ranks 3rd in the world now. So it does acknowledges there is a slowdown in the growth story, but it also argues for reorienting the policy towards the wealth creation in the economy by promoting more market economy, less government intervention, promoting entrepreneurship, and also reforming the financial sector. I mean, it is acknowledged that in the banks and the NBFCs, we have a problem which is leading to this kind of slowdown. So I think that that may be a way out, that you reorient your policy making towards promoting investment and promoting entrepreneurship. Worrying factor, yes, of course. I mean, the growth is going down. That is a worrying factor, and I hope so it will pick up next year, because we have several policies in pipeline, as sir was also talking about, massive investment in the infrastructure. And also I think this world economy is also going to pick up as it is being projected in the next year. So that will also have a positive impact on our exports and other things.
Okay. Global headwinds, I'll come to that in just a bit. But before that, Mr. Bhattacharya, this is something that we've been talking about over the last 1 week. We've been talking about promoting exports. We've been talking about how exports it needs to pick up really if we need to look at growing at 9% or maybe even 10% at some point in the future. So even the economic survey acknowledges that particular fact. It talks about promoting exports. It talks about getting rid of red tape as far as the ports are concerned. So if we want to grow at 6 or 6.5% in in the next fiscal? How important is this factor going to be? The export
absolutely.
issue?
I think you hit the nail on the head. I think the economic survey rightly underlines the need for boosting exports. I have not looked at the survey in very close detail, but the sense I got was that there is a lot of focus on the ease of doing business, which impinges on exports. There is not adequate focus, in my view, on the role of the exchange rate policy. But on the whole, there is, I think, well-merited focus and emphasis on exports. There are two other areas which the survey focuses on in its overall scheme of things, to create more wealth as well as to boost growth. One, I think it is unambiguously, it underlines the need for disinvestment, and actually it creates a table over the last 10 years to show that how public sector undertakings which have been disinvested, how they have done in the market in realizing more value and creating more wealth for the investors. And the unmistakable and unambiguous conclusion, that study in the survey, given in the survey in one chapter, is that PSUs which have been privatized or disinvested have actually done better for the remaining shareholders and even for the companies after their privatization. So the clear message from the survey here is that disinvestment and privatization are going to be very critical, very important. So if you are looking for some pointers to what the finance minister might do tomorrow, clearly if the survey is an indication where the chief economic advisor is clearly batting for more disinvestment and showing through numbers that more disinvestment and privatized companies have actually done better in the stock market as well as for the investor, is a clear point. And the second point, I think it tries to drive home is by creating a new term, I would say, is called thalinomics, and it mentions that how the last 11 to 12 years, how the thalinomics, which is an index based on how much does ordinary Indian spend on a vegetable thali and how much does an ordinary Indian spend on a non-vegetarian thali. And it shows that 2006-7 to 2018-19, a vegetarian thali person, the person who is buying a vegetable thali, is actually made that gained by 29%. In a sense, the vegetable thali prices have dropped, and the person who is spending his money, resources on buying that vegetable thali is actually become more affordable by 29%, and if he is a non-vegetarian thali guy, he is becoming more affordable by 19%. So it essentially trying to map the state of the country, the Indian economy, through different methods. As I said earlier, that measuring the health of the financial sector, a new index, measuring what Indians are eating and how well are they eating, and how affordable has ordinary thali become. I think economic survey over the years have gone beyond just presenting an assessment of the state of the economy, and always come up with new ideas, new tools for understanding what is happening in the country, in the economy. So this survey has also maintained the same tradition and giving us something new to think about and ponder over.
Indeed, something new to think about and ponder about. Thalinomics is it's interesting. It's a really interesting idea. But then taking the discussion forward now, Ms. Dasgupta, let's talk about the global headwinds, because that's something that the economic survey talks about as well. Can we expect an uptick in the global economy in the immediate next 3 months or 6 months? How much of an impact is it going to have on our economy? How much of an impact have the global headwinds had on the Indian economy in the year gone by?
In the year gone by, of course, the major thing which was troubling people was the US-China trade war. But that having been resolved to a certain extent through its phase 1 deal, which of course is only an intermediate step. So concerns on that score, I think, have been set at rest to a certain extent. But the major worry now is about the US and Iran. And if it were to blow up, what would happen to oil prices, to various other aspects of industries which are connected to the oil sector? Of course, oil still drives a very large part of the industries across the world. So the US, of course, has been saying that, and we have seen the figures, the US no longer depends on Middle Eastern oil and gas for its own requirements. It is self-sufficient. It is in fact exporting also in reasonable measure. So, but on the other major consuming countries like China, like India, it will definitely have a very serious impact. So one needs to keep our fingers crossed, and I think the IMF also has pointed in this direction, that there are some issues which hopefully will get resolved or will not get escalated further, and then the global economy can pick up. But if there is a downturn in those events, in those scenarios, then the global economy will also suffer, and as a consequence, the Indian economy will definitely take a knock.
Okay, all right. The economic survey also talks about the fact that domestic financial sector issues have had a strain or a drain on the Indian economy. How soon do we need to fix this mess of the domestic financial sector, Abhinav?
Yeah, that's true. I mean, before coming to that, I would just like to add that the economic survey has championed for more privatization by showing that it benefits the companies which were privatized, they are performing better. But it also argues for lots of deregulations. It's arguing for repeal of the Essential Commodities Act. It's arguing for the repeal of the Factories Act. It is also saying the Food Corporation of India needs to be completely restructured because the objective reality has changed. So in that sense, it is also arguing for more pro-market, pro-business reform, as opposed to what you say, the pro-crony capitalism which has prevailed for a long time. And coming to the financial sector, yes, it says that both the banking sector and the NBFCs, the crisis in them has dragged down the investment and has led to a very negative impact on the GDP growth rate, and that need to be fixed. It also argues that we need to modernize both our banking sector and the NBFC sector by the use of new technology, artificial intelligence, big data analysis. It is basically arguing that the government sets up a GSTN kind of a body which can gather the data from the different banks and use that for the big data analysis to guide the flow of the credit, and also to forecast the points of trouble and emerging areas of concern. It also basically flags very important point that the NBFC sector has been borrowing too much short term, and its obligations have been no long term. So that mismatch needs to be taken care of, and also by bridging the asymmetry in the information. That is also a major concern which economic survey is flagging in the banking sector.
Ms. Bhattacharya, your thoughts on the financial sector mess, and and how we can get out of it, and how it has actually been pulling back the Indian economy?
It's a very interesting point the economic survey touches upon, that among the many downsides that the Indian economy faces in achieving 6 to 6.5% growth next year, among the downsides, it lists the factors. There are many factors like the global headwinds that you mentioned. It mentions the slow process of resolution of stressed assets under the Insolvency and Bankruptcy Code. And I think it's an area where the government has taken a lot of steps in making the law more stringent, more alert to the changing scenarios, bringing about amendments to plug loopholes. But the fact is that it is still not reached a point where the resolution of stress assets is not a problem that the economy needs to deal with. And the worry comes from, and the economic survey does not mention it, but I would imagine that it comes from the latest financial stability report that the RBI had produced, in which it talked about actually a growth in the financial sector's NPAs to 9.9% by September 2020 from 9.3% in April 2019. So while IBC has made its contribution, made a positive impact, but clearly more steps and vigilance is required to make sure that the banking sector's ability to provide finances and credit for economic activity is not a constraint. So that is something that the survey recognizes, and survey underlines the need for early resolution of the stressed loans. Having said that, what the survey also hints at is financial innovation, and I think it really underlines, and it has been actually many surveys in the past have been doing it, but it doesn't ignore the need for developing a corporate debt market, because the Indian financial system is so overtly and dependent on the banking sector, unlike in many other developing and even developed markets, that we need to create alternative channels of loans and investments for the corporate sector, so that they don't need only to rely on the banking sector. If they don't, they go for the foreign loans, which are risk prone. So I think we need to develop that domestic corporate debt market, and the survey rightly underlines such measures to be taken.
Certainly, and talking about measures, there are some more measures, of course, banking reforms, something that Mr. Bhattacharya has already spoken about, talks about reforms as far as ease of doing business is concerned, it talks about labour reforms as well. How important is it, Mr. Dasgupta, for us to get all these reforms in place?
Well, the economic survey also projects that 4 crore jobs could be created by 2025, and it talks about exports as being the main vehicle for creation of jobs. Of course, the other sectors will also grow. Now, if we want to have exports, and it talks about an interesting concept of assemble in India for the world, which is, I think, hasn't been talked about as much in the recent past, because we have been talking about make in India or made in India, that the whole thing gets produced in India. Now we are talking about producing components and hooking on to the global value chain, which is not as difficult as making end-to-end, starting from scratch raw materials to the finished product. So if we have to do that, we will have to import intermediate products, components, and we will have to add further value to them and probably finish some of them and export the rest after some degree of value addition. For that, ports would be important, airports would be important, clearances would be important, and ease of doing business, registering a company. There are 4 things which the economic survey mentions, enforcement of contracts, payment of taxes, registration of property. Now, most of these things, registration of property, for instance, is a state subject, and there have to be reforms in all these areas. Otherwise, we have climbed a lot to 63 in the ease of doing business, but we are not among the first 50. So the economic survey also makes the point that we need to break into the first 50 and keep moving up. Otherwise, this projection or this plan of creation of 4 crore jobs, of also out of the $5 trillion economy of 2025, 1 trillion will be contributed by exports. That may not be achieved unless we carry out very robust domestic reforms, which will encompass labor, land, connectivity, and the other aspects of ease of doing business.
Certainly. And Abhinav Prakash, close the show for us with your concluding remarks on what we could possibly expect in the budget after what we've seen in the economic survey.
Well, that's a very tough question to answer. We'll have to wait for tomorrow. But I think we are going to see some announcement which is going to move towards more deregulation. We expect to see a fiscally expansionary budget and also some major steps taken towards the financial stability. And we should also focus not just on the labor reforms as we were talking about, but also on something which is very important, that is judicial reform in this country. If you can just reform the judiciary, lots of things will fall in place and that will have a direct impact on the GDP growth rate. But certainly that's not the topic of the budget tomorrow. We'll have to wait for it. I hope so the government will do that.
Mr. Bhattacharya, I'll let you have the last say on the program. I'll pick your brain as a journalist and let you tell us what you possibly think will be there in the budget from what you've seen in the economic survey.
Well, I think it will be cautious in its fiscal approach, in a sense that it will not go out of the way to be, in its exuberance. It will not go out and produce a figure for next year which will upset the market. If I take one lesson from this survey that was presented, the survey itself is quite conservative with regard to both fiscal imbalance in the domestic economy and external imbalance. It is actually cautioning the government that if you want to spend more money, please remember, spend it in a manner that it doesn't raise interest rates in the market. And if you want the private sector to borrow money, don't make them too dependent on foreign borrowing, because that may affect your current account balance. So I think the overall message of this survey is, yes, the economy should grow faster, but don't be so exuberant that what people say, don't be irrationally exuberant.
Right.
Be rational.
Okay, all right, be rational. Don't be irrational is what Mr. Bhattacharya is suggesting. We'll have to wait just for the night to go by and we'll know exactly what is in the budget, what's in it for you, what's in it for me, and what's in it for everyone else. Thank you to all my guests for joining me on the program, putting things into perspective for us. Our budget coverage will be live from 8 a.m. in the morning right up to 11 p.m. in the night. So do stay tuned to Rajya Sabha TV for all the latest on the budget as well. That's it from me. See you again next time.